If you own a home in Austin, Texas, Tampa, Florida, or Atlanta, Georgia, this is a serious heads up. The housing market that we all got used to over the last few years is changing. And for these specific cities, a market correction isn't a question of if, but a discussion of when and how much. Forecasters are looking at 2026, and the picture they're painting is concerning, as a wave of housing inventory is on a collision course with affordability that's already stretched thin. For homeowners in these three cities, the window to sell and protect your equity seems to be closing. Getting out now could be one of the most important financial decisions you make. In this video, we're going to break down the data to show you exactly why these markets are flashing warning signs, where the risk is coming from, and what it all means for you. And before we get into it, if you get any value out of this breakdown, do me a favor and hit that subscribe button. My whole job is to analyze the data to help you stay ahead of what's happening in real estate, and your support helps me do that. To really understand the risk that's building in Austin, Tampa, and Atlanta, we have to zoom out and look at the national picture. Right now, the U.S. housing market isn't one single story. It's really a tale of two completely different markets. On one side, you've got areas with a chronic shortage of homes, mostly in the Northeast and parts of the Midwest. Markets like Hartford, Connecticut are still starved for inventory, with active listings way down from where they were before the pandemic. This scarcity keeps prices propped up and keeps sellers firmly in the driver's seat. But on the other side, you have the Sun Belt. During the pandemic, these states were ground zero for a huge migration and building boom. That boom has now created a real vulnerability. In a lot of these southern and western cities, the number of homes for sale has not only recovered, but in some cases has shot past pre-pandemic levels. This surge in supply is happening at the exact moment that affordability is getting crushed. Now, mortgage rates have given us a little relief, easing from their 2025 peaks, but most major forecasts from groups like the Mortgage Bankers Association and Fannie Mae expect rates to settle somewhere in the mid 5% to low 6% range by the end of 2026. While some projections are a bit higher, landing around 6.3%, the overall picture is that rates aren't dropping low enough to cancel out the huge price gains of the last few years. This combination, a glut of homes for sale and borrowing costs that are still high, is putting downward pressure on prices, especially in these overbuilt Sunbelt cities. While national home prices are expected to see modest growth, with many forecasts from Zillow, NAR, and CoreLogic projecting gains in the 2 to 4% range for 2026, that national average is hiding the significant risk of a correction in certain pockets of the country. Our first stop, and the clearest example of this, is Austin, Texas. No city in America better captures the pandemic housing frenzy and the hangover that followed than Austin. From 2020 to mid-2022, prices went vertical as remote workers and tech companies poured in. But that explosive growth got totally disconnected from the local economy, and now the correction is here. Let's look at the numbers. According to the Austin Board of Realtors, median home prices in the area have already fallen significantly from their dizzying peak of around $538,000 in May 2022, down to about $430,000 by late 2025. That's already a roughly 20% pullback that has given some affordability back to buyers. But the correction might not be over. The heart of Austin's problem is a massive amount of inventory. The number of homes for sale has surged from the pandemic lows. In late 2025, Austin's housing supply is sitting at around 5 to 6 months of inventory, which is a huge shift from the feeding frenzy of 2021 and puts the market closer to favoring buyers. This isn't just the market getting back to normal, it's a genuine oversupply. There are simply more homes for sale than there are buyers who can afford them at today's prices. You can see this imbalance in every key metric. The average time a home spends on the market has stretched out, with the median days on market sitting closer to 40 to 60 days, roughly 1.5 to 2 months. That's a world away from the 2021 market where homes were gone in a weekend. Sales volumes are also dropping. While some reports comparing sales to the absolute peak show steep declines, even the more moderate year-over-year figures show demand is struggling to keep up with all the new listings. And resale homeowners have another problem: home builders. Austin was a hot spot for new construction, and builders are now sitting on a ton of homes they need to sell. To do that, they're offering aggressive incentives that the average homeowner just can't match, like major price cuts and mortgage rate buydowns that can get a buyer's rate into the 5% range. This pulls buyers away from the resale market and forces regular homeowners to cut their prices to compete. So where does the market go from here? While mainstream forecasts are mixed, some private analyses suggest prices could continue to drift down through mid-2026, One detailed projection argues that a sustainable median price for Austin, based on local incomes, might be closer to the $390,000 to $400,000 range. If the market is currently around $430,000, that implies there could still be another 10% of downside risk before finding a bottom, potentially in late 2026 or early 2027. For homeowners in Austin, the data suggests the risk is tilted to the downside. The chance to sell at the absolute top is past, but the chance to sell before a potential bottom may be right now. Next, we head east to Tampa, Florida. Tampa also had a massive pandemic boom, but its risk is unique. It's a dangerous mix of runaway new construction and a full-blown property insurance crisis that is strangling demand. Like Austin, parts of the Tampa metro area are seeing a huge increase in homes for sale. Inventory levels are way up from the historic lows of a few years ago. One analysis from the channel Reventure News even suggested that Tampa has one of the highest inventory surpluses in the country. While that's one interpretation, there's no denying the supply of homes is growing rapidly. This rise in supply is creating a much tougher market for sellers. Homes are sitting on the market longer, with some data from Realtor.com pointing to a median of 73 days in late 2025, and more sellers are being forced to cut their prices. But what makes Tampa's situation so risky is the property insurance crisis. This isn't a small problem. It's changing the entire market. A mix of increased storm risk and lawsuits has caused insurance companies to flee the state, and the ones that are left have jacked up their prices to unbelievable levels. The average insurance premium in Florida has skyrocketed. While statewide average premiums were already over $1,800 5 years ago, they're now commonly in the $4,000 to $6,000 range. And for homeowners in coastal or higher risk areas, quotes of $7,000 to $10,000 a year are becoming a harsh reality. Think about what that does to what someone can afford. A buyer might be able to handle the mortgage on a $400,000 home, but can they afford that plus an extra $600 a month for insurance? For a lot of people, the answer is no. This is killing purchasing power and pushing a huge number of potential buyers to the sidelines. This is creating a toxic situation. At the exact same time that a wave of inventory is hitting the market, demand is being crushed by the insurance crisis. And when supply goes up and demand goes down, prices don't have much room to go anywhere but down. While public indexes from sources like Zillow or CoreLogic show a mixed bag for Tampa prices in 2025, with some data points showing modest declines, the underlying fundamentals are getting weaker. For homeowners in Tampa, it's not just about mortgage rates. It's about a uniquely local crisis that is rapidly tilting the market against them. We're about to get to our third and final city, where the situation is just as concerning. If you're finding this analysis valuable for your own financial decisions, please take a second to subscribe to the channel and hit the notification bell. My goal is to give you data-driven insights you won't get anywhere else, and your subscription makes that possible. Our final stop is Atlanta, Georgia. Atlanta's story is more of a slow motion shift than the dramatic boom and bust of Austin. The risks here aren't as obvious from a distance, but when you look at the data, you can see some of the same warning signs. The key theme in Atlanta is a creeping oversupply combined with slowing demand. For years, Atlanta was seen as relatively affordable, but that has changed. Prices rose steadily, and now the market is starting to feel the pressure. Let's start with inventory. Like our other two cities, the number of homes for sale in the Atlanta metro has climbed, with the Atlanta Realtors Association reporting around 3 to 3.5 months of supply in late 2025. While that's not as high as Austin, it's a big jump from a year prior and signals a move toward a more balanced market, which takes away the upward pressure on prices and introduces downside risk. At the same time, demand is clearly getting weaker, home sales are down, and homes are sitting longer. Zillow data from late 2025 showed homes sitting on the market for a median of 66 days before going under contract, another sign of a major slowdown. What's concerning is that Atlanta seems to be on a similar path as Austin, just a bit delayed. The citywide price data might look flat, but that hides what's happening in specific neighborhoods. A closer look shows that some zip codes, especially in the suburbs that saw the biggest pandemic price jumps, are already seeing modest price drops. This is often how a broader market correction starts, with weakness on the edges that slowly moves toward the center. Even most mainstream 2026 forecasts from sources like Zillow now project flat to only slightly positive growth for Atlanta. While a small gain doesn't sound scary, it's a huge change in momentum from the strong growth of the past few years. The underlying dynamics are showing worrying similarities to other Sunbelt cities. More homes for sale, slower sales, longer market times, and the first hints of price weakness. For homeowners who have been watching their equity grow for years, These are the classic signs that the top of the market cycle is behind us. The risk is that Atlanta is simply a year behind Austin on the same path toward a more meaningful correction. Now, it's really important to understand that this is not me predicting a nationwide housing crash. Like I said at the start, it's a tale of two markets. To prove the point, just look at a market like Hartford, Connecticut. The situation there is the complete opposite of what we're seeing in the Sun Belt. According to Realtor.com, the Hartford Metro has dramatically less inventory than its pre-pandemic average, with some reports citing figures as high as 74% below normal levels. This is an extreme inventory shortage. Instead of homes sitting for weeks, they're still getting intense buyer competition. This scarcity creates a safety net under prices. In fact, while Austin, Tampa, and Atlanta face the risk of price declines, some bullish forecast scenarios for markets like Hartford project strong price gains in the coming year, with some high-end projections suggesting potential gains as high as 9.5%. The dynamics couldn't be more different. This contrast is key because it shows that the warnings for Austin, Tampa, and Atlanta aren't based on generic nationwide fear. They are based on specific, local, data-driven factors. A huge surge in the supply of homes that is running headfirst into affordability problems. So let's tie this all together. For homeowners in Austin, Tampa, and Atlanta, the message from the data is getting harder to ignore. The party that started in 2020 is winding down. In Austin, you have the clearest example of a boom-bust cycle with a massive inventory surplus and downward pressure from builder incentives, creating a high risk of more price corrections. In Tampa, you're facing a double threat. A similar surge in inventory combined with a devastating property insurance crisis that is actively hurting buyer demand. And in Atlanta, you have a market showing the early but clear warning signs of following that same path, with creeping oversupply and weakening demand pointing to a potential correction on the horizon. For owners in these three cities, the next 12 to 18 months represent a critical period. This may be the last good chance to sell and lock in the historic equity you've made before the market potentially softens even more. Waiting for a potential bottom, which some analysts think might not come until late 2026 or 2027, is a risky bet. Selling now, even if you don't get the absolute peak price of 2022, could be a smart move to protect your financial position in the face of these specific mounting risks. What are you seeing in your city? Are these trends happening in your neighborhood? Let me know your thoughts in the comments below. I read every single one. And finally, if you want to keep getting data-driven, no-hype analysis to help you navigate this tricky housing market, make sure you're subscribed and have hit that notification bell for future updates. Thanks for watching.